Morning. Welcome back to the webinar. Hope you've had a good month. We're talking this time about Warren Buffett, one of the greatest investors of all time, and lots to talk about in markets and geopolitics. So let's get into that in that order. Let's do markets first before we do geopolitics and a bit of Buffett. So it's all about tech. It's been about tech for a while. Let's look at last year's numbers. This is the Magnificent Seven, just to remind you. Nvidia, chip maker for all things AI, up 240%. Meta up also about 200%. Tesla up 100%. Amazon up 80%. Alphabet up 60%, which is Google. Microsoft up 60%. Apple up 50%. S&P only up 20%. So if you were in tech, then you were struggling. And you were struggling with profits as well, because look at these profits numbers. This shows you actually the Magnificent Six, not the Magnificent Seven. It's leaving out Tesla. Got a bit of problems at the moment. These are Q4 earnings growth. Magnificent Six up 53.7% year on year 2023. Excluding the Magnificent Six, the other 494 companies, profits went down by 10%. So the market's kind of struggling in terms of profits growth, unless you're very big tech. This year, this year to date, same bunch of stocks, but just the first 3 months of this year. Nvidia up 91% again, extraordinary. It's about a $2 trillion company now. Meta's up 44%, Amazon up, Microsoft up, Google kind of flat, but Apple is down 7%, struggling a little bit with the iPhone sales. Tesla's down close on 30%. So much more difference between these outcomes this year. Between the Magnificent Seven. So let's see what's going on there. Nvidia, earnings revisions. These are the Magnificent Seven earnings revisions. You can see Nvidia at the top there. And to be fair to Nvidia, profits growth has exploded. Enormous demand for chips which run AI modeling. And Nvidia is really the only game in town right now. And so their profits have exploded. And the share price has exploded. That's fair. At the bottom of this chart in red, Tesla is the red line, and profits are down, give or take 20-30%. Just come up with some bad numbers just the other day as well. So we're seeing some problems here and some kind of greatness when it comes to Nvidia. And you can see this in the share price. On the right-hand side of this chart is Nvidia. That share price has gone to the moon. And on the left-hand side, you can't always really compare these things, but it's kind of interesting to do it now and again. This is, on the left-hand side, Cisco. Back in the 1999 tech bubble, when Cisco was the backbone for the internet, the new internet. It was the backbone, it was the routers. Cisco was the darling stock of the day. Nvidia is the backbone, the chip maker, for the AI revolution, the darling stock of the day. And whilst I'm all in favor of, or a believer in, the progression from AI, which is extraordinary and changing all our lives very quickly. Nvidia's position as pretty much a monopoly supplier of these chips right now is it's a position which may not be sustainable because other people are going to come in. So competitors, Microsoft's making its own chips now. Google is making its own chips now. Amazon is making its own chips now to compete with Nvidia. So Nvidia's margins, which are 55% operating margins, those are abnormally high profit margins. So just mind your eye a little bit when you get this amount of hype around a single name, like Nvidia. Tesla, on the other hand, is being carried out by the Chinese. This is the latest Chinese electric vehicle. You can see the Chinese spelling there, Xiaomi. Which is pronounced Gmar. Get that? Gmar, I think. I'll not try to pronounce that again, I don't think. Anyway, a very large supplier of mobile telephones. And 3 years ago, they said, we're going to make an electric vehicle from scratch. And this is it. And if you look at their factory, which produces this amazing car, the SU7, it is simply built by robots. There is not a human inside. Quite an extraordinary achievement. It will have a top speed, or has a top speed, of 265 kilometers per hour with an 800 kilometer range, electric vehicle, and 0 to 60 miles per hour in like less than 3 seconds. In other words, it's as good as, if not better than Tesla. And Tesla to date, like Nvidia, I guess, has had this monopoly position in electric vehicles. There are now 100 electric vehicle manufacturers in China. BYD is an enormous one. These guys are clearly going to be very big. And these cars are luxurious, they're beautifully made, they run very well, and they're about half the price of a Tesla. So Tesla's got some issues it'll need to grapple with, which is why it's going down. But technology is still around a third of the market cap of the US. The last time it was a third of the market cap of the US was the 1999 tech boom and then bust, when these tech companies fell by 90% in short order. It's now a third of the market again. So there's some frothiness there, some hype I've been talking about for a little while. Let's see how that plays out in coming months. And the market overall is a little bit expensive. Again, we've talked about this. This is the Shiller-Cape ratio. It's the price-earnings ratio based on normalized earnings. So they take kind of 10 years of profits to kind of normalize them, take the average of that, and the price over that earnings number. And on that basis, the market is on around 30 times. That's pretty expensive. And what this chart kind of shows you is in the blue line, is the subsequent 10 years returns from the market, from that valuation point. So if the market's quite expensive, then your forecasted returns you can expect are going to be lower because you're coming from a higher valuation. And that kind of solves to kind of a 0 to 5% return over the next 10 years, if this relationship holds. So that's another way of describing the market as being expensive, is that expect lower returns on a forward-looking basis. And at the moment, corporate insiders, by which they mean corporate directors, so directors of companies, are not buying the market, they are selling it in quite large numbers. It's quite an alarming chart. This is into this year, and the corporate insider transaction ratio is very much flashing a red signal, a warning sign in terms of the market itself. Meanwhile, the economy in the United States continues to confuse, quite honestly. Parts of the economy, very many parts of the economy, continue to be very strong. This is jobs growth. So jobs growth is running at between 200,000 and 300,000 per month, positive. That's very strong jobs growth. So the employment market is strong, and unemployment is low. And yet, in the housing market, house prices seem to be declining, which isn't really a headline anywhere. This shows you home price declines in the last crash, which was the global financial crisis, 2008, 2009, fell by about 25%. They're currently falling by about 20%. So parts of the economy are really struggling at a time when you've got inflation stubbornly high. It's kind of stuck at about 3.5%. We had that print overnight. US inflation is still at 3.5%. I've been saying for a long time, it'll come down from 7-8% to 3 to 4%, but getting to 2%, which is the Fed target, is very difficult. So you've got stubbornly high inflation right now. That's going to be a theme for the next few months. And can the Fed reduce rates? Or they may even have to raise rates next year if they don't get this inflation thing under control. That's not in the market at this point. Okay, that's markets. And a continuing note of caution, I guess, is what I'm trying to convey in terms of markets generally. Okay, geopolitics. This was the interview between Tucker Carlson and President Putin. Tucker Carlson used to be a Fox News anchor, left and set up on X, the Twitter platform, or the old Twitter platform. And this interview aired about 2 months ago. It got 200 million views within 3 days, a lot more than Fox News gets. So keep an eye on X for your news feed. Quite a good source of news, as long as you're careful in terms of fake news versus real news. This interview ran for 2 hours. It got completely chastised by the Western media. I thought it was actually very interesting. It's an interesting watch. And whatever you think of Putin, and I think it's probably fair to say he lives in the bad actor camp. Whatever you think of him, he's not a madman. Very rational, gives some interesting historical context in terms of the Ukrainian dispute, and offered an olive branch in terms of settling on the Ukraine conflict. Very clearly, he said, I'm willing to talk, I'm willing to have peace negotiations. That was just not reported in the Western media. We do need to have these conversations, and they're not happening. He also made an interesting point in terms of the expansion of NATO towards Russia's borders. And we can't dispute the fact that NATO has expanded towards the border of Russia and to the border of Russia. That's quite a threatening move to a country. And in 1999, according to Putin, and I think this has been verified, Putin actually asked President Clinton, US president at the time, whether Russia could join in NATO. Extraordinary question. Now, NATO was set up as a defensive pact against Russia. So Russia joining NATO turns NATO into an all-encompassing political organization, which kind of cements peace between those two entities. Putin said to Clinton, can we join NATO? And Clinton said, well, actually, you probably can. That would be great. But I need to check with my advisors first. This is over dinner. Clinton checks with his advisors, and the next morning says to President Putin, actually, no, my guys think that's a bad idea. You can't. And this was a kind of a constant rebuffing of Russia at that time. And if you think back 20 years, 25 years, Russia was being embraced by the West, or Russia was trying to be embraced by the West and becoming a Western civilized kind of nation. But the problem from Putin's point of view, that it constantly got rebuffed in terms of that process. And fast forward to today, that's clearly a big part of what's been going on, allied with the expansion of NATO, along with that rebuffing, the expansion of NATO towards and to the Russian border. And it got to the point where Ukraine, Russia said, this is a red line. Ukraine cannot become a member of NATO. We need Ukraine to remain neutral. And the US said time and time again that Ukraine would become a member of NATO. And indeed, just last week, or 10 days ago, at the NATO Leadership Summit, Secretary of State Blinken, who clearly, these are Biden's words as well, reiterated again that Ukraine would become a member of NATO. Now, and quote, sooner rather than later, if Ukraine becomes a member of NATO, then Article 5 of NATO states that if any member of NATO is attacked, then every member of NATO defends that member. So if Ukraine becomes a member of NATO, it's currently being attacked by Russia. So at that point, the US would have to defend Ukraine with troops on the ground. And then we're at war with Russia. This is very dangerous brinkmanship. And I'm not sure what Biden's playing at, but it's extremely dangerous. And take a look at this expansion of NATO, just to, I guess, prove my point. I'm not saying Russia's a good actor here. I'm just stating some facts in terms of what's actually happened. This is the NATO alliance in 1992, okay, just after the Berlin Wall came down and just after the Soviet Union collapsed and became Russia. 1992. The countries in blue are members of NATO at that point. Russia on the right in red, and the white countries, Sweden, Finland, Poland, Belarus, Lithuania, Romania, Hungary, etc., kind of a buffer zone between the West, NATO, and Russia, a safety zone. Fast forward to 2021, these countries are part of NATO. This map's a little bit misleading because Ukraine is not a member of NATO, but it's a member of a partnership for peace, so it shouldn't really be kind of blue, and nor is Belarus. But outside of that, Sweden and Finland have now become members of NATO as of last year. Finland, on the border of Russia, is now a NATO member as of last year. Estonia, Lithuania, Poland, Romania, Hungary, all now members of NATO. There is no buffer zone anymore, apart from Ukraine and Belarus. This is why Ukraine was such a big deal for Russia. Can you imagine if, and by the way, we've got nuclear weapons and conventional weapons armed NATO within these countries. Can you imagine if Russia developed a pact with Mexico and put nuclear weapons on the Mexican border with America? That would be pretty aggressive. It's exactly what we're doing in Europe. It's very foolish in my view, and we need to step back from the brink. And Ukraine did used to be part of Russia. This is a quote from, I think, the Encyclopedia Britannica. Ukraine, the name formerly given to a district of European Russia, now comprising the governments of, etc. So Russia has a claim here. And we need to find a peaceful resolution to the situation. And if we don't find one, then President Trump, when he does get in November, will settle it for us. But peace, some kind of agreement needs to be reached. I'm very clear on that, because heading this way to the brink is not smart. And meanwhile, Putin, of course, is spending now. This is military spending in Russia, $120 billion a year, funded by oil sales, of course, to China, India, etc. In the face of sanctions from the West. Military spending in Russia is about a third of GDP now. So massive military spending at a time when Europe is not spending very much on military. Trump called out the European states for not spending their declared promises of 2% of GDP on defense. They're still not spending it. This is the UK that's just about spending it. And Europe is struggling even to supply ammunition for the Ukrainian forces now. It can't produce it fast enough. So the West, Europe is weak, and Russia is getting stronger. And Russia, by the way, is winning the war in Ukraine. It is pushing the Ukrainian forces back as we speak. So again, a settlement needs to be made to resolve that situation. China, kind of migrating into the global south, kind of BRICS kind of argument. China is now, to remind people, the largest naval power in the world. It has, give or take, 350 naval warships, which is more than America has. It's dominant now in the South China Seas. And if you want to be a global power, or a dominant global power, you have to control the seas. And that's where China's heading. And it's also heading to domination economically. This is a chart which shows its trade with the Belt and Road countries, the Belt and Road Initiative. It's an $8 trillion initiative to economically coerce, I think it's something like 86 countries into its orbit. Its trade with those countries now exceeds the trade it does with the US, Europe, and Japan combined. So you're seeing a shift of power, economically and militarily, from west to east. And this has been reflected in a number of things. One of them is gold. I've been talking about gold for a little while. This is the gold purchases by central banks annually. That's pretty much doubled over the last couple of years, partly in response to the US response to the Ukrainian invasion by Russia, which was to freeze, confiscate Russian foreign exchange reserves, which were held in dollars and US treasuries. And those have been removed from Russia, $300 billion worth. So what do you think Russia and other enemy states are going to do with their foreign exchange reserves? They're not going to hold US treasuries anymore, US dollars. They're going to hold something they can physically hold, literally in their vault, beneath their central bank, which is gold bars. So massive demand for gold. And that's part of the reason that the gold price has done what it's done. Again, I've been talking about this for a little while. It's gone from $1,850, $1,900 an ounce to $2,350 an ounce just in the last few months. So it's finally kind of broken free, if you like, and a massive demand coming in for gold. And gold as a kind of a hard, real asset is also benefiting from the response to the US kind of empire money printing. And at this stage of empire and decline of empire, massive money printing tends to happen. 1/3 of GDP was printed, and the more US dollars there are around, the less valuable a US dollar should be. So in time, the US dollar will decline, and people are looking for hard assets to hide in away from that US dollar decline. One is gold and one is crypto. These days, crypto is seen as a hard asset, dare I say. Bitcoin hitting fresh highs again, above $70,000, and Ethereum, or Ether, it's cryptocurrency for the Ethereum blockchain. Ethereum hitting $3,800. So I expect this to continue, the shift to safer, non-US dollar hard assets. Big trend happening at the moment. And one thing which reinforces that kind of always is when the large institutions like us pile into this thing. BlackRock has now embraced crypto, having been a massive skeptic. They've launched a tokenized fund, which is a fund which you or I would buy, but it lives on the blockchain, powered by Ethereum, and is much easier to transact in. and it's called a tokenized fund as opposed to a unit trust. And the more that happens, the more things live on the blockchain, the more they're powered by Ethereum, the more Ethereum you need, the higher the Ethereum price goes. So when the institutions pile in, we need to take note. And crypto usage, by the way, is growing. This is a chart which shows you in the white line, internet adoption back in the day, and in the light blue line, cryptocurrency adoption. And this is not cryptocurrency speculation. It's using crypto as part of a blockchain technology to create new processes in financial services, in legals, in contracts, etc. Things are now moving to the blockchain. It is happening, and I expect this to continue, and will continue to support cryptocurrencies as a result. And I think finally, Trump is ahead in the polls quite clearly. These are the latest ones here. Trump is ahead of Biden. In the key swing states, 7 key swing states in America, Trump is ahead by between 2% and 6%. That's a big lead in those swing states. And if you win those swing states, you win the election. So I do expect Trump to win the election, and I expect him to be more forthright in his foreign policy and much more, it'll be chaotic, but it'll be much stronger against the emerging strongmen, President Xi, President Putin, President Erdogan, Mohammed bin Salman in Saudi Arabia, Iran now flexing its muscles. So Biden's allowed that strength to come through. I think Trump will stand up to it. I think, again, like Trump or loathe him, and I think he probably is a very difficult human being, he will be stronger than Biden, in my opinion. And whilst it'll be chaotic, you may get a better kind of world, more balanced world order as a result. Okay, time to get into Warren Buffett and Charlie Munger and Berkshire Hathaway. Charlie Munger on the left, Warren Buffett on the right. I have the great good fortune to be in Omaha in about a month's time to go to the Berkshire Hathaway AGM. And to remind people, Berkshire Hathaway is probably the longest standing successful investment firm of all time. It now has a 60-year track record, 6 decades, with Warren Buffett in charge and Charlie Munger as his vice chairman. Warren Buffett is the chairman. And Charlie Munger, sadly, died aged 99, 30 days short of his 100th birthday, in December last year. And Charlie Munger was an extraordinary lieutenant to Warren Buffett, and some would say led him as opposed to the other way around. Because just going back, I mean, 1978 was when Charlie Munger joined Berkshire Hathaway, which really got going kind of late 60s. 1978, Charlie Munger joined and really shifted Warren Buffett from a deep value investor, just buying cheap companies, often not very good companies, to an investor who invested in what we now know Warren Buffett for, which is companies with long-term sustainable business models which generate high returns on capital and compound over long periods of time, like Coca-Cola, the classic example. And it was Charlie who really shifted Warren that way. So we can thank Charlie Munger for quite a lot, and I'm sure, and I know Warren Buffett does, in his latest letter to shareholders, he's been very explicit on that. And an extraordinary track record. So let's look at the track record over that 60-year period, give or take. By the way, Warren Buffett is 93, so, you know, time to go and see him. His successor is going to be a chap called Greg Abel. I hope he is able, who runs the non-insurance operations for Berkshire Hathaway right now. He's been there for about 25 years. So he'll be at the AGM as well. It'll be interesting to see how he does. This track record, though, over 60 or so years. Okay, Berkshire Hathaway, up, what is that? 4.4 million%. It's quite a lot, 60 years. Same 60-year period, S&P 500, its benchmark, up 31,000%, as opposed to 4.4 million%. So that's obviously extraordinary. Give or take 20% per annum for 60 years, S&P 10% per annum for 60 years. So a clearly extraordinary track record. So how has he done that? There's been some kind of tricks in the background, as well as some investment nuggets, which we will get to. Let's look at his portfolio currently. This is his portfolio of listed securities, okay? It's a listed portfolio, and a private equity unlisted portfolio. This is the listed one. 45% of the portfolio currently in Apple. Wow. Okay, so half his portfolio is in one name. If I, as a fund manager, as a professional fund manager, went to a client with half my portfolio in one name, they would immediately force me to reduce it to whatever, 10%, or they'd fire me. It's way too concentrated. So Buffett has always run very concentrated portfolios. So these 10 names are pretty much the whole portfolio. A normal professional investor would have 30 names, 40 names. So highly concentrated, so a lot depends on how Apple does. Look at the other names. I looked at this a few years ago when I first did some work on this. Of the top 10 names, I think 6 were financial services companies. Now we've got 3 left: Bank of America, American Express, and Moody's. Now, Bank of America is one of those banks which has become ginormous in America, along with people like JP Morgan and Citigroup. And they have become the dominant players as the US banking industry has consolidated massively. So huge beneficiaries of this, what's become almost an oligopoly at the top. And these banks have become too big to fail, which is a problem in the global financial crisis. They were too big to fail. The taxpayer had to bail them out, and now they're even bigger still. So that's a problem actually for America and for capitalism generally, and certainly for taxpayers. But Warren Buffett has ridden that wave, and he's invested in banks and has done extraordinarily well out of that trend. Not a well-documented thing. Other names: 2 oil companies, Chevron and Occidental Petroleum. Those are relatively new names. And then Mitsubishi and Mitsui, one of 7 Japanese brokerage holdings of all things. And out of the list, I'd say there's 1, maybe 2, the one being Coca-Cola, which kind of fall into the long-term sustainable, franchised, big moat, protectable brand businesses, Coca-Cola. Just one name. So Buffett's made his money in all kinds of different ways, not just that kind of folksy, let's buy a great name we all understand thing. And the other trick, or smart move, has been his unlisted portfolio. And this is it. So what Berkshire Hathaway is a listed portfolio and a private equity unlisted portfolio. And that combination is measured against the S&P 500. Clever trick. So the private equity portfolio is not marked to market every day. It's marked to market every year or so. So much smoother path of returns. So that much smoother path of returns really makes you look good against a very volatile S&P 500. And private equity also gives you generally higher returns than quoted businesses, because you've got the illiquidity premium of private businesses. So again, that natural premium in private equity gives you a natural edge when you're trying to beat the S&P 500. Clever trick. The other trick is the genius of buying Geico, which is one of the largest insurance businesses in the world, and using what's called the float to invest in equities and gearing the whole thing up. So if you think about a life insurance business, we pay our life insurance premiums every month, and when we die, we get the money back, plus a return. In the meantime, the money stays with the insurer. That's the float. The insurer can invest it as it wishes, as long as it pays you back at the end. Now, a normal insurer will invest kind of 20 to maybe 40% in equity markets, okay, which are risky. It'll generally stay in kind of safe things because it's got to pay you back at the end. 20 to 40%. Geico, under Buffett, invests 80% in equity markets. So a massively leveraged impact on its equity returns. It can do that because it keeps massive amounts of capital on one side in case it gets it wrong. So Geico's been a wonderful kind of a mechanism within Berkshire Hathaway to supercharge those returns. The other one's railroads. It owns one of the big railroads across America and is a massive owner of utility businesses, particularly electricity. So none of which are kind of folksy Coca-Cola names. A very different way to generate returns. They turn out to be very high return on capital businesses. So very clever construct, but also underlying it, some investing nuggets of gold in terms of the way Warren Buffett and Charlie Munger go away choosing the companies they buy. And I've kind of distilled what are lots of lessons from Warren Buffett into one slide. These, I think, are the most important ones at the core of what he does. And let's spend 5 minutes on this. Number one, buy businesses, not stocks. Sounds simple, but when you're looking at a share to buy, you're looking at the share price, how's it done, what's the price earnings ratio, what are people saying about it? No. When you're looking at a share to buy, pretend you're buying the whole business. Not a share in it, the whole thing. Okay, so I'm going to buy the entirety of Apple. What that does, it makes you focus on the business. Let's say it's Apple. How does it make its money? What gives it its edge? What allows it to generate high returns if it does? What will make those high returns be sustainable, which is the second point, over long periods of time? Because if you don't believe that the returns are going to be sustainable, you shouldn't be buying the company in the first place. And if you're buying the whole company, you're in for quite a long time. Okay, that's the mentality when you buy anything. It's so critical. Then you really get to understand how Apple makes its money. How does Apple make its money? Apple makes its money because it's got a phenomenal brand and phenomenal design, which persuades people it's a luxury product, and therefore they pay a luxury price, and Apple can produce them at scale. No one else has been able to do that in technology. It's quite an extraordinary business model. Can that be sustained? Okay, one can debate that. But look for companies with sustainable competitive advantage. Third point, never invest in a business you can't understand. Again, sounds obvious. People often do. Let's say you buy Nvidia now. Okay, it's a chip maker. How does it make its chips? Well, it doesn't make its chips. It designs them and TSMC makes them. Okay, how does that work? What are the chips? They're GPUs. What are GPUs? They're graphic processing units. Nvidia was set up as a chip maker to facilitate gaming machines. Gaming machines, heavy video, very high processing power required, and these GPUs were the only ones fast enough to drive those computer games. Fast forward to now, they turn out to be the only chips fast enough to drive AI modeling. They've been very lucky to have landed in that space, and suddenly they've got this monopoly as a maker of very fast chips. Is that a sustainable business model? I suspect not, because there's nothing to stop the competitors catching up, and they're catching up straight away. You better understand that before you buy Nvidia. Number four, invest in companies with high and sustainable return on capital. This is critical. It goes back to the first couple of points. Companies with high and sustainable return. Well, you better understand what return on capital is. Okay, it's not a price earnings ratio. It's not a dividend yield. It's like you're buying the whole business. Okay, you're supplying the capital. You're putting £100 in. What return are you going to get on that £100? Okay, what is the cash return you get on the capital deployed? That's what you need to know, and you need to know what that is compared to the cost of the capital. So let's say you work it out, and the company is making 12% return on your capital. Very good, very good. What's your cost of capital? These days, probably 7-8%. Let's call it 8%. So you're making a 4% excess return. That is extremely good. If the company can reinvest that excess return at again 12%, that'll compound that excess return over time. That's the engine at the core of what Berkshire Hathaway does. Excess returns on capital reinvested in the same business, compounding over long periods of time. Great. You better be clear that 12% is going to be sustained or increased, because if it starts to go down, your share price is going to be toasted. I can tell you that. As soon as you get a high return company which starts to fail, then everything goes into reverse. So you need to understand, what is the return on capital? Is it high enough to exceed your cost of capital? Is it sustainable over time? This is where it becomes complicated. Buffett makes it sound easy. Very hard to find those kinds of companies. Better to buy a wonderful company at a fair price than a fair company at a wonderful price. This is, don't be a deep value investor, which is let's just buy fairly average businesses, but at really cheap. Let's buy great businesses and pay a fair price for them. Again, easy to say, quite hard to do. But that's a big shift away from Benjamin Graham. So Warren Buffett moved away from Ben Graham in 1978 when he met Charlie Munger. He now invests in wonderful companies at fair prices, not fair companies at wonderful prices. And the last one, be patient. This goes back to buy the business, not the stock. If you're not prepared to be in it for 10 years, don't buy it for 10 minutes, quote unquote Buffett. Be patient. You can only be patient with an investment if you have faith and full understanding in the business itself and its ability to generate sustainable returns for you. You have to have that belief set. Otherwise, all you end up doing is just looking at the share price and just panicking and selling it out at a low point because you can't take the pain anymore. You have to have a true north, which allows you to be patient, which is the belief system in the company story, which is based on your work and evidence. That's the core of what Warren Buffett does. Now, in the last 15 years, just to wrap this up, on the flip side of the coin, Buffett hasn't had a very good track record. 60 years, extraordinary. Last 15 years, I should say this, forgive me before I get to that. This is important. Read and think. To reinforce the points I've previously made in terms of being patient. Quote unquote, I insist on a lot of time being spent, almost every day, I'll say every day, to just sit and think. Okay? You have to read and read and read. Books, newspapers, articles, everything you get your hands on. Read, sit and read. And then think. So few people do this because there's so many distractions these days. Take time to think. Ideally go for a walk for half an hour. Not with the AirPods in, just walk and think about the investment you're looking at or the business you're assessing or your life, whatever it is. Read and think. This again is at the core of the patient success of Warren Buffett. But in the last 15 years, he could have been fired. This is the performance of Berkshire Hathaway over the last 15 years since 2009. Berkshire Hathaway is at the bottom in white. Above it is the S&P 500 in red. And above that is the NASDAQ. So you can see that Buffett has underperformed his benchmark, in fact, by 1% per annum, give or take, for 15 years. If I, as a professional fund manager, went to a client with a 15-year track record of 1% underperformance per annum for 15 years, I would be fired. But Buffett isn't, because his reputation is extraordinary, and his 60-year track record is still extraordinary. But I don't think it's the best in the world. And I'll finish on this chart. This is a list of some great, some not so great investors of all time. The penultimate one at the bottom is Warren Buffett, Berkshire Hathaway. 60 years, certainly the longest, 20% per annum, extraordinary. Extraordinary, full stop. Below him, Ray Dalio, 12%. Ray Dalio talks a very good book at Bridgewater, and the returns can be good, but they're not stellar. I'd say he talks better than his numbers suggest. Above them, Peter Lynch at Magellan, 29%, but only for 13 years. A Walk Down Wall Street, I think it was called, Peter Lynch's book, Magellan. Revered as an amazing fund manager, but only a 13-year track record. So I wouldn't put him up there, alongside Buffett for sure. Above him is someone I put on the list more with mischief than anything else, but he's had good returns as Stephen Cohen from SAC. I spent a little bit of time meeting with that firm, and if you watch the program Billions, then the main character is modeled on Stephen Cohen. And Stephen Cohen has had various run-ins with the SEC. He is still operating, 0.72, generated good returns, but in my opinion, not in the correct way. Above him, George Soros, Quantum, extraordinary. That's a macro fund, very different to stock picking, 32% per annum for 30 years. That is extraordinary. George Soros is up there, despite his various political views, and he's getting quite old now. As an investor, as a macro investor, extraordinary. But the best is Jim Simons, who no one's ever heard of, at Medallion. Jim Simons was a maths professor, set up Medallion when he was 54 years old. I've written a paper on this, 20-year track record, did 39% annualized return. This is a quant hedge fund. Okay. His fees were such, 5% and up to 40% performance fee. His gross of fee annual return was 66% per annum for 20 years. Net of fees, 39%. Gross of fees, 66% per annum. He's one of the first quant investors, or certainly one of the first great quant investors, and found small anomalies in the market and pursued them mathematically with more and more powerful quantitative machines and extracted alpha from the market in a quite extraordinary way. So Jim Simons actually is the greatest investor of all time. Warren Buffett is the greatest fundamental investor of all time and has used various mechanisms, call them tricks, call them mechanisms embedded in the structure of Berkshire Hathaway to allow him to do that. But he's done it in an extraordinary way. And what's important is that the way he approaches investing and his principles, which I've attempted to summarize here, can help all of us in the way we approach our investing lives and our lives generally. And for those nuggets of gold in investment, he is known and revered, and rightly so. And I very much look forward to seeing with 20,000 other people at the Berkshire Hathaway AGM in Omaha and spending time with Warren Buffett and his succession team. I hope that's been helpful. I'll report back from the Omaha event and look forward to speaking to you soon. Take care. Bye-bye.